How will multifamily real estate investors navigate the supercharged uncertainty in the Canadian commercial real estate market? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. In a recent keynote address at the Vancouver Real Estate Forum, CBRE Chairman Paul Morisuti highlighted the ongoing challenges facing the Canadian commercial real estate market. Despite hopes for economic normalization in 2025, the industry continues to grapple with decreased immigration, stricter borrowing conditions, and persistent challenges in office usage. The trade policies of former U.S. President Donald Trump have only added to the uncertainty, casting a shadow over investor and occupier sentiment. However, Benjamin Tal, Managing Director and Deputy Chief Economist at CIBC Capital Markets, offered a glimmer of hope. He suggested that the uncertainty created by Trump's policies cannot last indefinitely. With the U.S. midterm elections approaching and various economic pressures mounting, Tal predicted a renegotiation of the United States-Mexico-Canada agreement with more targeted tariffs at lower percentages than currently in place. This could lead to a more sustainable equilibrium. Turning to the office market, Morisuti noted that liquidity remains a challenge, with lenders being selective about financing projects. Rising costs related to sustainability and tenant experience are also increasing the expenses of owning and operating office buildings. Yet, there are positive signs. Canada has experienced minimal distress in the office sector, and markets like Toronto and Vancouver are seeing a decrease in vacancy rates, particularly in high-quality office spaces. This trend is expected to continue through 2026, offering some optimism for investors. In the retail sector, the slowing economy and tariff uncertainties present significant challenges. However, necessity-based and discount retail continue to perform well, with national vacancies below 4%, indicating a relative strength in this asset class. Meanwhile, the industrial sector, despite facing low vacancy rates and high rents, remains fundamentally sound. Canadian rents have doubled over the past 5 years, and major markets continue to be among the tightest in North America. Finally, the residential market, particularly in cities like Toronto and Vancouver, is facing a short-term cyclical issue with record numbers of unsold condos. Yet, Morisuti sees potential for a resurgence in demand as immigration growth normalizes and construction slows down. This could lead to a shortage of available units in the coming years, potentially sparking another condo boom. As always, it's essential to keep a long-term perspective and look for opportunities amidst the challenges. In a significant move for the Canadian industrial real estate sector, Montreal-based developer Rosefellow has acquired a 1.2 million square foot portion of the megacenter Notre Dame in Laval. With an investment of approximately $200 million, Rosefellow plans to transform the site into a state-of-the-art distribution and light industrial complex. This development will span 550,000 square feet across 3 buildings, emphasizing sustainability and innovation. Rosefellow co-chief executive officer Mike Jaeger shared that the company intends to begin demolition of the existing retail center as soon as the current leases expire and tenants are relocated by the end of the year. Interestingly, the decision to focus on industrial redevelopment was driven by high demand for industrial space in the area. Jaeger highlighted that despite an overall industrial vacancy rate of around 5%, Class A industrial spaces with over 40-foot clear height have a vacancy rate of just 0.2%. The location of the megacenter Notre Dame site offers exceptional visibility and access to the regional transportation network, making it an attractive option for industrial development. Jaeger noted the strategic advantage of having a range of retail and service amenities next door, akin to strategies employed in the office sector to attract tenants. The proximity to services such as gyms, grocery stores, and restaurants, coupled with a robust labor pool, enhances the site's appeal. Rosefellow's commitment to sustainability is evident in their plans to incorporate energy-saving features and target at least LEED Silver certification for the project. The company is also planning for net zero operations and may integrate innovative elements to further enhance sustainability. This aligns with Rosefellow's broader strategy, as they aim to invest approximately $450 million in the Laval area in the coming months, signaling a strong commitment to long-term growth and economic vitality. According to Jaeger's co-chief executive officer, Sam Sumas, this acquisition represents a major step in Rosefellow's development activities in Laval and underscores their dedication to investing in prime locations. Rosefellow has been a significant player in Eastern Canada's industrial real estate market since its founding in 2019, having acquired over 31 million square feet of land and completed 22 projects valued at $3.1 billion. With plans to deliver more than 6.4 million square feet of additional industrial space by 2026, Rosefellow is poised to make a substantial impact on the market. Next, we're exploring an intriguing development story from the Vancouver area, where OpenForm Properties is making waves in the commercial real estate sector. According to RENX, OpenForm Properties, an offshoot of Vancouver's Open Road Auto Group, is leveraging its automotive roots to drive its real estate ventures forward. OpenForm is actively developing projects on sites previously occupied by car dealerships, taking advantage of updated area plans that allow for higher density. OpenForm's president, Jason Turcotte, shared with RENX that the company's foray into real estate began about 8 years ago. The Chia family who founded Open Road recognized the potential of their land assets and launched OpenForm as a parallel business unit. This strategic move has enabled them to maximize the value of their existing properties, particularly in urban areas where car dealerships have shifted to smaller operations. OpenForm's portfolio is diverse, encompassing high-rise condos, mixed-use employment spaces, and residential rentals. Turcotte emphasized their opportunistic approach, focusing on well-located properties where their design-forward approach is appreciated. Notably, OpenForm is not solely reliant on existing assets. They are actively seeking new opportunities and partnerships to expand their development pipeline. One of OpenForm's notable projects is the redevelopment of the former Open Road Honda Burnaby location. After a lengthy rezoning process, they are now pursuing a second rezoning under Burnaby's new height-based framework. The current proposal includes a 35-story condo tower and a 25-story rental tower, totaling 718 homes, along with a commercial component featuring retail and office space. Another exciting venture is the planned mixed-use employment building at the current Vancouver BMW location. The site, set for renewal, presents an opportunity for comprehensive development, combining retail, office, light industrial spaces, and the BMW dealership itself. This project is indicative of OpenForm's innovative approach to transforming older dealership sites into vibrant, multi-use developments. OpenForm is also making strides with a light industrial/office building in Mount Pleasant, known as 288W8. This 6-story building offers a unique opportunity for businesses to own their workspace with a blend of light industrial and office spaces. The top level features an amenity space with a communal kitchen and work lounge, enhancing the building's appeal as a modern workspace. Jason Turcotte acknowledged the current market challenges, noting that developers face unprecedented headwinds across all asset classes. Despite elevated construction costs and macroeconomic issues, Turcotte remains optimistic, highlighting that smart decisions can still lead to successful projects. OpenForm is navigating these challenges by focusing on strategic locations and innovative designs that meet market demands. With OpenForm's proactive approach and the strategic use of its land assets, the company is well positioned to make a significant impact in the Vancouver real estate market. Their ability to adapt and innovate in the face of challenges exemplifies the resilience and creativity needed in today's complex landscape. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.